Okay, so let's go ahead and start to take a look at the slides from Chapter 4. And what I want to first do is just take a look at a couple of questions. This is actually from your homework in Connect, and this is really giving us a transition from where we were in Chapter 3 to where we're going in Chapter 4. And you can see that we're trying to determine which of the following concepts are pervasive in the application of generally accepted auditing standards, particularly standards of field work and reporting. And obviously you can see Connect pointed the answer to us here. Materiality, which was where we left off in Chapter 3, is something that is very pervasive. And then the idea of audit risk. And when we bring these two issues together, this drives much of what we do as we complete the planning process, and then as we move into our testing phase, which will start to be the subjects of our next couple of chapters, as we'll wrap up the discussion of internal control in Chapter 5, and then after our midterm, as we start to move into some of the actual procedures that we do to test the account balances, what we determine about materiality and audit risk will drive much of what we do as we do our detailed testing. Another question here: the existence of audit risk is recognized by the statement in the auditor's standard report that the auditor obtains reasonable assurance about whether the financial statements are free of material misstatement. So what we're going to learn here with audit risk is there is always a chance that there will be a material misstatement in the financial statements, and we will not identify that. And we talked about that way back in Chapters 1 and 2. No, not that far back. We're only in Chapter 4 now, but back in those chapters we talked about that, and that we only provide reasonable, not absolute assurance. And so this concept of audit risk is going to leave that doubt, essentially, that there's always a chance that there will be a material misstatement that we will not be able to identify in the financial statements. So let's just go ahead and take a look at the process that we are going to discuss in this chapter. And we're going to talk about assessing the entity's business risk. And this is beyond risk related to the financial statements. This is just what are the entity's business risks that they face from changes in regulation, etc. We will then, of course, since we're auditing the financial statements, want to relate those risks to what could go wrong at the account balance level. And this is where the auditor thinks about something called potential misstatement. Why don't we just go ahead and put that potential misstatement. Okay, and the auditor needs to think about that potential misstatement, and literally the auditor is actually kind of creative here when we look at the entity's business risk and then translate those into potential misstatement that occur on the financial statements. We will then look at various factors, including the inherent risk associated with that, the control risk associated with that potential misstatement, and that will drive the assessment of the risk of material misstatement. And we then mitigate that risk of material misstatement by lowering or adjusting our detection risk appropriately, and then therefore keep our audit risk at a low level. And this is where we're going with much of our discussion for this chapter. And of course, as I mentioned in the introduction, we're also going to see how these factors would relate to the auditor's assessment that there'll be a risk of material misstatement due to fraud. Okay, so we're going to get reasonable assurance that the financial statements are free of material misstatement. We talked about materiality in Chapter 3, and we saw how materiality was a material misstatement would be something that would change the decision of the users of financial statements in making their investment and credit decisions. And now we want to understand what are examples when we really talk about misstatements. What do we mean by those? Okay, And I'm going to go ahead and group these into a couple of different categories here. So I'm going to put a box around this first set here. Okay, and this box here we could call factual misstatements. Okay, if something is a factual misstatement, that means that that's factual, that's an F there, factual misstatement, that means that the auditor has applied a procedure, maybe has sent a confirmation letter to our client's customer asking if they owe a certain amount of money. The client's customer has come back and said, no, we do not. We investigate and we find out that there was a misstatement in the account receivable. This is a factual misstatement. It deals with the facts that there was an omission of an amount, or it could even be a disclosure. In that example, we have the omission of amount. Or there was some financial statement, disclosure, or presentation that is not in accordance with generally accepted accounting principles. But we would consider these factual misstatements. Now, some misstatements that we come up with comes from when we say an incorrect accounting estimate. Well, we don't agree with management's estimate. Management has determined, for example, that an asset will have a 10-year life, say for a truck. We go and we inspect that truck to take a look at it, and we believe that this truck only has a 2-year life. Well, who's right? Maybe management's right, maybe we're right, but the auditor has to use their best judgment, and if we have a difference of opinion in terms of accounting estimates, then that would be considered a judgmental misstatement. And so this is actually a second category for these, and I'm just going to go ahead and put a box around those. And so if you take a look at this category of misstatements here, we are going to call this blue box here judgmental misstatements. And I'll just go ahead and put that over to the side. These are going to be judgmental. Okay, that's a judgmental misstatement when there's a difference of opinion about accounting estimates. That's considered judgmental misstatement. Now, they don't show a category here for another type of misstatement that we would want to consider, because we'll get into that more when we talk about our sampling in later chapters. But there's also something called projected misstatement. Projected misstatement is based on our sampling procedure, where we will project based on the sample to the population what we think the misstatement to be. So we have really three categories. Let's just count them. Factual misstatement, we can have judgmental misstatement, and then we can have projected misstatement. And again, they're not really showing examples here. Projected misstatement would come from the application of sampling procedures. So let's go ahead and take a look at a couple questions here about misstatements. And we are talking here about accounting estimates in this first one, along the lines of the misstatements that we were talking about coming from estimates, judgmental misstatements. And we say when assessing the risk of material misstatement, which we will get into the assessment of the risk of material misstatement here in the next couple slides coming up. But an auditor normally would be concerned about assumptions that are susceptible to bias. Connect has pointed out to us as the answer here. And by saying that that is susceptible to bias, estimates, in which there's a certain amount of subjectivity there, and we would look for bias with those estimates if, for example, they tended to overstate revenues, understate expenses, overstate assets, understate liabilities. Those would be the type of biases that we would be looking at. And then we talk about which of the following is a factual misstatement. Fixed asset being recorded at the incorrect cost. We see for example, an invoice showing that they paid one amount, and then we see it being recorded in the financial statements at an incorrect amount. Obviously, a factual misstatement. You look at the rest of these management estimates, projected misstatements, difference about judgment, those are all clearly judgmental misstatements, and so the only one that would fall into our category of factual misstatement would be fixed asset being recorded at an incorrect cost. Okay, so let's go ahead and get into now really the new information that we're going to be focusing quite a bit on here, which is the assessment of risk. And these assessment of risks and the outcome of this assessment is going to drive then what we really start to do as we look at how the internal controls of the company will help prevent or detect that misstatement, and then how the auditor will then adjust their detection risk accordingly, and that will then to a large extent drive the timing, extent, and nature of our further audit procedures, and that will guide us into Chapter 5 and then into much of the detailed work that we'll do in the various account balances as we move through our later chapters. So let's just go ahead and let's take a look at this notion of business risk. And we're going to be understanding what sort of business risk that you see right here, what sort of business risk could affect the company. And we talk about our client, and we talk about significant conditions, events, circumstances. For example, let's say we have a client that is an oil producer. Conditions, events, circumstances could be the potential for, say, some sort of environmental issues or regulation that could be affecting their business risk, and this really is something that affects their ability to execute their strategies. Example, I have mentioned that I was on audit of the Bureau of Public Debt. And of course, we have this issue of the debt ceiling where the debt cannot go over a certain amount. That would clearly affect the day-to-day operations. That would be a business risk factor that would affect, for example, the Bureau of Public Debt. But from the auditor standpoint, we are concerned as to the potential misstatement that could result from these business risks. So although we understand business risk, we're not here to help necessarily assess the profitability of the company or give them recommendations along those lines in addressing the business risk. We are concerned as to how that would have effect on the potential for a material misstatement in the financial statements. We're auditing the financial statements. Okay, so let's go ahead and take a look at this slide, and we saw this in Chapter 3, and we're talking about our risk assessment procedures. Now remember, we said that risk assessment procedures always have to be done on every audit, and I'm calling this Step 1. The standards don't call it Step 1, but I'm calling it Step 1 because what we determine in this step, we will go ahead and determine what we will do in Step 2. Most of our discussion in this Chapter 4, is going to be focusing on this phase. This is really our focus, and then we'll get into the Step 2 procedures more in Chapter 5. Okay, but I've given you another way of talking about the risk assessment procedures. It's also been called obtaining an understanding phase, and I've given you this silly mnemonic here, DIRE, so that you remember what some of the key words are associated with this. It's looking at the design, implementation, and then making an assessment of risk. We're going to assess the risk of material misstatement. And this Step 1 is done in every audit, and in these audits, the auditor is to obtain an understanding of the internal control of the entity and their environment that they operate in. Remember, we were just looking at business risk a minute ago. Sufficient to evaluate the design of the controls and determine that the controls have been implemented. This always has to be done in every audit. That leads us to the assessment of risk. That's the A and the R up here in our little mnemonic. And that then leads us to the assessment of the risk of material misstatement. And again, we always have to do those procedures in every audit. And then based on that assessment of risk of material misstatement, that's going to drive what we do in step 2. If we assess that risk of material misstatement at the maximum, we're going to follow this red arrow over here on the next slide and go directly to our substantive testing, and we will not test the operating effectiveness of the internal controls. If we assess that risk of material misstatement at less than the maximum, then we will test the operating effectiveness of the internal controls and go then to our substantive testing. And so notice that we're going to be assessing these risks in every engagement, and then what we do in that next step is predicated on what happens in this step 1. So let's just go over to the next slide, and let's say that the auditor had assessed the risk of material misstatement at less than the maximum. Okay, so we know that we're going to test the operating effectiveness of the controls, and so you go over and we're now in step 2, and step 2 has also been referred to in literature as a test of details phase, and we're now in step 2. And what we do in step 2 is determine on the assessment of the risk of material misstatement that happened in step 1. So again, we were following from the previous slide. If we'd assess the risk of material misstatement at less than the maximum, say at low or medium, then the auditor would test the operating effectiveness. And that's a key phrase. That's why I bolded that. We would test the operating effectiveness of the controls. And we do that sometimes, again, because it depends on whether we had assessed the risk of material misstatement at the maximum or not. If we had assessed the risk of material misstatement at the maximum, we wouldn't do this testing of the operating effectiveness. But if we assessed at less than the maximum, low or medium, we would first test the operating effectiveness of the controls, and then we would do our substantive testing. And we always have to do some amount of substantive testing, even if we had assessed the risk of material misstatement at the maximum, in which case we would have followed the red arrow from the previous slide. We would not have tested the operating effectiveness of the controls. We would have skipped that and gone straight to substantive testing. Thus, our comment that we will always do some amount of substantive testing. Okay, so again, every audit, the auditor is to do what? Obtain an understanding of the internal control sufficient to evaluate the design of the controls, determine the controls have been implemented. Those are our risk assessment procedures. We're calling that step 1. Has to be done in every audit. We could also call that obtaining an understanding phase. If we assess the risk of material misstatement at the maximum, then we will first test the operating effectiveness of the controls and then do our substantive testing. If we had assessed the risk of material misstatement at less than the maximum, then we would not test the operating effectiveness controls and go directly to our substantive testing, and that was the red arrow that came over from the previous page. Always have to do some amount of substantive testing for our testing of the operating effectiveness controls. Again, it depends on our assessments from step 1. Now, this part we're going to talk about more in chapter 5 that you see on this slide now. Really, the balance of our discussion for chapter 4 here is going to be filling in details under step 1. So, let's go ahead and see how we are going to consider various factors in making that assessment of the risk of material misstatement. And so when we look at the assessment of the risk of material misstatement, we are going to see that we are going to look at something called inherent risk and control risk. Inherent risk and control risk, those combined together are called our risk of material misstatement, or our M that we just saw on the previous slide. Now, these are put together in terms of our notion of audit risk. Okay, audit risk is the risk that the auditor will unknowingly give the incorrect opinion on the financial statements. The auditor will say that the financial statements are not materially misstated, provide an unmodified or unqualified opinion, when in fact there is a material misstatement in the financial statement. The auditor failed to detect that misstatement and gave the wrong opinion. We should have qualified our opinion. Maybe it was so bad we even should have given an adverse opinion. Now, certainly, auditors don't want this to happen. This is the definition of audit failure. So, in trying to make sure that we have detected material misstatements, we will consider the inherent risk. Inherent risk in an account is something that the auditor cannot control. Inherent risk is a combination of the risk associated with the account balance itself, but also remember we consider environmental factors of the entity. For example, cash tends to have a high inherent risk. Transactions that are susceptible to significant estimates tend to have an inherent risk. Unusually complex transactions, if our client has derivatives, is going to be subject to a high inherent risk. Okay, so we look at those inherent risk factors. Now, all the examples that I just gave you there related to raising the inherent risk. Some accounts could have a lower inherent risk. For example, I've mentioned that I've been on the audit of the consolidated financial statements for the federal government with my agency, the Government Accountability Office. And when we look at those consolidated financial statements for the federal government, in a footnote, the federal government discloses their heritage assets, things like the Washington Monument, the Lincoln Memorial, and they value those at $1. So what do you think? Probably a low inherent risk, low dollar value, a disclosure issue, footnote disclosure issue, and it's not very likely that someone's going to walk off with the Washington Monument in the middle of the night. But again, we consider environmental factors, such as maybe there's some concern about security related to the Washington Monument. So, we would look at both environmental factors and the actual account or disclosure as well in determining our inherent risk. Cash, for example, might be more susceptible to theft if the economy is not doing as well. Okay, so it's not just in the account balance itself for our inherent risk, it's also environmental factors. Then what? Then we would look at the controls. What internal controls does the client have that will help prevent or detect that inherent risk or mitigate that inherent risk? Try to prevent or detect misstatement in the financial statements by mitigating the inherent risk. Once we have looked at the combination of those two, the inherent risk and the control risk, then the auditor controls their detection risk. And the auditor can control their detection risk through substantive testing. To the extent that we do substantive testing, we can, nature, extent, and timing of our substantive testing, we can control our detection risk in response to our assessment of the risk and material misstatement, and that helps the auditor to keep the audit risk, and we would probably want to keep that low. We certainly don't want a high audit risk. Okay, so let's just go over, before we talk about these factors that could lead to our detection risk, and let's just go over, and I'm going to give you an example here with the on the next slide with our audit risk. And let's just visualize here for a second. Let's say we're going to audit a jewelry shop. Okay, we want to audit a jewelry shop, and we're going to want to make our assessment of our audit risk. Okay, and make our assessment of our risk and material misstatement, and then control that through our detection risk. Now, when we look at our risk and material misstatement, again, we consider inherent risk, and we consider our control risk. Okay, now let's just say we're going to audit this jewelry shop, and we look at the nature of their business, and they're of course selling, rings and diamonds and small items that are high value, that are probably pretty easy to steal, and we're considering maybe a bad economy. Okay, so based on that, we go ahead, we look at their business risk, we look at that, and we say, well, there's a potential for misstatement there through maybe something being stolen, etc. And we'll talk about fraud a little bit later, but just keep that in mind here, that we are assessing our inherent risk at maximum. And notice we can go ahead and call that out qualitatively, but notice I have put a 1 here. We're going to actually do a numeric example. So the auditor wants to keep their audit risk low. Okay, we want to keep our audit risk low. That's a qualitative way of saying it, but we also could do that numerically. We want to keep our audit risk at 0.05. That means that there's only a 5% chance that we would give the incorrect opinion on the financial statements. We're trying to control that, keep that low. Only 5% chance that there would be a material misstatement in the financial statements. We look at the business risk. We look at the environmental factors affecting this client, jewelry shop, diamonds, rings, bad economy. We say, you know what, inherent risk is at the maximum. So we assess that at maximum. Qualitative assessment. Quantitative assessment, we put it at 1. Then we go ahead and we would start to consider the control risk. And we talk to the client about their internal controls. And for this particular client, they don't describe much of what sounds like quality internal controls to us. They say, well, we lock the door at the end of the night, and we leave all the diamonds and rings out in the cases, and we leave the lights on so no one can sneak around in the dark or something ridiculous like that. We look at that and we think, wow, those are not good controls. So we assess control risk at the maximum. We assess that at 1. So we've done a qualitative and quantitative characterization here, and the auditor could use either, could use both, but we have assessed both inherent risk and control risk at the maximum. So now what? Now we want to keep our detection risk low so that we can keep our audit risk low. So we go ahead and we set our now our detection risk at 0.05, obviously, so that our audit risk stays at 0.05. Now, how will we keep our detection risk at low? Well, that will then determine our substantive testing, and we're going to talk about nature, extent, timing, and we're going to get more into this in some of our other chapters, but just taking a look here. Nature means we're going to look for a more effective audit procedure. For example, we might use external evidence rather than internal evidence. Remember, we talked about evidence before, and external evidence tends to be more reliable because there's less opportunity for the client to alter that. The external party is not part of the company, so they're going to be more inclined to give a more open, honest response. There's less bias there, and so we would want to rely more on external evidence, again, to keep our detection risk low so that our audit risk is low. So external evidence is more reliable. It's coming from outside the company. Extent, larger sample sizes. When we pull our sample for our substantive testing, the more items we look at, the more potential there is that we will not have a misrepresentative sample. We lower the potential. Better way to articulate that there will be a misrepresentative sample. So we're going to want to take larger sample sizes, and for our testing, we'll do our testing at year end. If you think about our internal controls, and let's say we have this is a rain cloud up here, okay, and the rain cloud is going to rain misstatements. Okay, this is a misstatement rain cloud. and it's raining misstatements. And down here is our financial statement. Okay, and this is the beginning of the year. This is the end of the year, right? And it's raining misstatements. Well, we don't have good internal control. All of that rain is just hitting the financial statements. And as we're trying to wrap up the financial statements towards the end of the year, it might rain a little harder. So what does the auditor do? The auditor really puts their bucket here, which is our substantive testing. I'll put ST for substantive testing. We put our bucket here at the end of the year, and we're going to do procedures that are going to allow us to sit there and squeegee all those misstatements off and find them through our substantive testing, because we know that those hit throughout the year, and we want to make sure that we design our procedures so we're close to the balance sheet date and we are catching those misstatements, particularly towards the end of the year as the client is wrapping up the financial statements. Now, and we're going to get more into the nature of these, extent and timing of these procedures more in our later chapters, but just at this point, we want to make sure that we understand that to lower our audit risk, if we have an inherent risk and control risk that has been set at the maximum, we lower our detection risk through our substantive testing, nature, extent, timing. Okay, so if we're trying to keep detection risk down, substantive testing is going to be up in this little graphic. Okay, now we finished that audit, and when we talk about extent of testing, I don't know, maybe we decided to look at every single day's worth of transactions. You say, well, John, that would be 100% audit. Well, if it's a small mom or pop audit shop, jewelry shop, maybe we can go ahead and do that. We can audit every single transaction, but we're going to really audit the heck out of this because of our concerns about the internal control and the obvious inherent risk. So we wrap up that audit, and then we go down the road, and let's say over on the next slide now, we audit another jewelry shop. Maybe that's our specialization, is auditing jewelry shops or something. So we come over, and again, we will do this in every audit. We're going to do our risk assessment procedures to help us determine our risk of material misstatement. And what happens? We have our inherent risk and our control risk that drive our risk of material misstatement, and we're going to see how those will affect our audit risk. And so our inherent risk, we are still assessing at maximum, because what? It's still the situation with the diamonds and rings, bad economy, so that doesn't change. Okay, that's going to be the same because it's still jewelry and it's still bad economy. Consider the environmental factors, consider the account itself, looking at the company's business risk, etc. And now we sit down with this company, and when we look at their internal control and we start to talk to them about it, they tell us, well, you know, we feel we have a pretty robust internal control. Okay, what we do with our internal control, the company tells us, is we have 2 staff that have to come in together in the morning. Each one has their own individual combination to open the safe. So no one person can open the safe themselves. All of the jewelry is taken out of the safe at that time in the morning, and we would then, they would then go ahead and put everything in the jewelry cases, take a complete inventory of everything that's there, confirm that all the things that were in the safe now are properly put into the cases, and there'd be an inventory that would be taken. Around the middle of the day, someone else comes in, and so there's always dual custody of all of our inventory of jewelry throughout the day. At the end of the night, they take another count of the inventory, make sure that of jewelry, make sure everything is there, and a supervisor signs off on an inventory control sheet. Everything goes back into the safe and is locked up at the end of the night, and there's cameras observing this whole process. So we look at that and say, you know what, that sounds pretty good. We're going to go ahead and assess our control risk at moderate. We can put it in terms of quantitative aspects and qualitative. So there's our qualitative, and quantitatively we put it at 0.50. Well, again, firm policy is to keep our audit risk low. Okay, we don't want a high audit risk, and so we would keep that at 0.05. But now, because we believe that we have more solid controls, we can go ahead and set our detection risk a little higher. Our detection risk is going to be a little higher. We're going to put it at 0.10. You don't say you have a high detection risk, but a higher detection risk at 0.10 now, and that would still, because of our satisfaction with the potential for these controls being pretty good, we would go ahead and set our detection risk a little higher, and our audit risk would still be at 0.05. So what happens? Well, now when we do our substantive testing, we control our detection risk through our substantive testing. Now notice we have a change here. Okay, we can go ahead and we can make some changes to how we have set up our substantive testing. Nature, we can use a less effective procedure. We can now use internal evidence. Extent for our control testing will be smaller sample sizes, and timing, now we can do some interim testing instead of waiting till year end to have to do a significant amount of testing. So again, there's our misstatement rain cloud. Okay, misstatements. Okay, and what happens? I'll just abbreviate that, misstatement. Okay, and here comes the rain, and here's our financial statements. Okay, and it's 1/1, and then we've got 12/31 over here, right? Okay, and it's raining down misstatements, but now we have a nice roof over that, and that roof is the internal control. Okay, and so since we have that nice roof now over our misstatement, I don't know, maybe a few drops leak through, but for the most part, we're thinking, okay, this is in pretty good shape. So what do? We go ahead and we set up our substantive testing, and if it was a 12/31 year end, maybe we're doing that at 9/30. Okay, and we can afford to go ahead and do that at interim now because we think we have pretty good internal controls and we're not worried about all that rain hitting the financial statements at the end of the year. Now, that does not mean that we do not roll forward. Do a roll forward. In other words, even though we may do our substantive testing and do most of our substantive testing at interim date there at 9/30, we would still do some maybe smaller amount of testing, or maybe do some analytical procedures towards the end of the year just to make sure that things have continued the way we have expected based on our interim testing at 9/30. Okay, but again, the takeaway here is notice that our substantive testing can be less extensive, okay, if the auditor has determined that we have a lower control risk, thus we can accept a little higher detection risk by altering the nature, extent, and timing of our substantive procedures. Now, we're not going to get too much into step 2 in this chapter, but we'll see that in this situation now, we'll get into having to test the controls, and we will test the operating effectiveness. Okay, the operating effectiveness of those controls. Now we'll have to do that because we have assessed the risk of material misstatement at less than the maximum based on our obtaining an understanding about the controls. The other thing that we would need to do at this point, remember, we look at the implementation and we look at the design when we're making that assessment. Okay, so we have to look at design, but we also have to look at implementation. Okay, design and implementation. design and implementation. And so what happens with the design, we kind of like this design, right? Cameras, people showing up at different, showing up together, dual custody of assets, all sounds pretty good. So what happens? We go ahead and we show up early one day, and we see that the two individuals actually show up together, and they each put in their combination and they follow the procedures. Well, now that control has been implemented, and so the auditor would say, we like the design, we like the implementation, now we're going to go test operating effectiveness. Okay, and this would be step 2. How would we test operating effectiveness? We would test operating effectiveness by maybe taking a sample of those inventory sheets that we said were signed off on by the supervisor. We would take that sample of sheets and see the signature. Maybe we look at 50 of those. Now, instead of looking at every single day's transactions, we're going to look at 50 of those inventory control sheets and do a dual purpose test on those, where we would also maybe do some substantive procedures over those as well. But because we had assessed the risk of material misstatement at less than the maximum by looking at the design, looking at the implementation, and we would walk that day's worth of transactions through the process, and we would see then that they followed the procedures, that control's been implemented, and then we would test operating effectiveness. And if we want to look at 50 days worth of transactions, all we'd have to do is look at 49 more. We don't have to throw away that day that we were there, but we would have to take some sort of sample to allow us to do our testing of the operating effectiveness. And then, of course, we always have to do substantive testing, nature, extent, timing, and we could start to use internal evidence. We would also, do our substantive testing on those 50 items. So we test the operating effectiveness, do our substantive testing, and we could do most of that at interim, although we would have to do some roll forward procedures. Now, the burning question must be, well, what happens if you look to see that the well-designed control is not implemented? I don't know. Only one person shows up and puts both combinations in because they've got some sort of situation where, they've made an arrangement. You sleep in on Monday, Wednesday, Friday this week. I'll sleep in Tuesday, Thursday, and we'll switch next week so everyone gets a chance to sleep in. And the day we're there, only one person comes in and they don't follow the procedures. Well, that means that control has not been implemented. And since it has not been implemented, even though it's well designed, we would go ahead and go back up to our control risk and now set that at maximum, and we would be back, and I'm not going to go back to the previous slide, but we would be back to the previous slide where we had assessed control risk to the maximum, and we would have to lower our audit risk through our substantive testing, nature, extent, timing, nature, using external evidence instead of internal evidence, extent, taking larger sample sizes, timing, doing year-end testing instead of interim testing. Okay, so all of this assessment process is our step 1, our risk assessment procedures, the focus of this chapter. This testing of operating effectiveness really gets to step 2 that we will discuss in more detail in the next chapters. That's step 2. Okay, and we'll get more into that in the later chapters. Okay, all right, so that gives us hopefully a nice sense of how we're considering audit risk. And you can see here that we're back to the slide where we talked about our factors now, and notice that our detection risk, there'll always be some level of detection risk. That's why you can never get detection risk at 0. You can never get audit risk at 0. Remember, it's reasonable assurance, not absolute. So there'll always be some amount of audit risk, and so we can never completely mitigate our risk of material misstatement through our audit procedures, and the reason being that there is this potential for sampling risk. We pull a sample, no matter how large that sample is, we pull a sample for our substantive testing, and there's always a chance that the sample will not be representative of the population. So that's sampling risk, and we'll just form a wrong conclusion based on the sample. can happen. You take a sample indicates there's not a material misstatement when in fact there is. And so we give the wrong opinion. We give a unmodified, unqualified opinion when we should have given a qualified opinion. Now there is also factors related, not related to sampling here, and we can see some of those. Inappropriate audit procedures, misinterpreting the audit evidence, failure to recognize the misstatement. In other words, we're human and we could make a mistake. Those are considered non-sampling risk. At least with sampling risk, we can quantify to what extent we're accepting, incurring some sort of sampling risk, and that doesn't want to let me circle it, but we can consider how our sampling risk, really we can quantify how much sampling risk we're taking. Non-sampling risk is a little tougher to quantify, but we do have both of these affecting our detection risk, and of course we can never completely eliminate our detection risk, thus our audit risk can never be zero. So we only give reasonable assurance. Okay, so let's go ahead and take a look at some questions, and these are ones that I took from Connect, from your homework and from your quiz in Connect. So you'll see these as you get into your homework and you get into your quiz for this chapter 4. But let's just take a look. And again, we're talking about the risk of material misstatement, and we say it is a combination of two components, and we've seen that: inherent risk and control risk. The risk that the auditor will conclude based on substantive procedures that a material error does not exist in the account balance when in fact such an error does exist is referred to as our detection risk. Okay, the risk that we will not detect that material misstatement and give the incorrect opinion. We try to control that through our detection risk, but remember we said there's always some level of detection risk, and thus there's always some level of audit risk, meaning that we will determine that there's not a material misstatement, in fact there is, and we'll give the incorrect opinion. Okay, taking a look at this next question from your quiz and from your homework. When an auditor increases the assessed level of risk of material misstatement, and again that means our IR and or our CR have gone up because of certain, in this case, okay, here we go, they're telling us it's because our CR has gone up, certain control procedures were deemed to be ineffective, the auditor would most likely increase, and then it's going to be what? Nature, extent, and timing of our substantive procedure. And they could have said here the auditor would use external evidence instead of internal evidence. They could have said the auditor would do their testing at year end or closer to the balance sheet date. This one chose to focus on extent, the sample size. So you can see how those terms that we learned there are helping us to answer the homework questions and the quiz questions. And don't forget, quiz, homework questions, particularly the quiz questions, but some of these that I've taken from the homework are actually pretty good, are going to translate into things. You'll see things just like this on your midterm, guys. Continuing over and looking at another question, which of the following is a source of detection risk? A non-representative sample, right? We have sampling factors, we have non-sampling factors that affect our detection risk. So nice set of questions there that relate to the material that we talked about on the previous slides that we just went through. Okay, good. So the auditor has to go ahead and do those risk assessment procedures. Well, what is the nature of those? Well, we're inquiring of management. Remember, in the jewelry shop, we ask them about their controls. We inquire about entity personnel. For example, we would maybe talk to those two employees about their procedures and their combinations and how they keep those up to date and their combinations and how they get those and keep them private, etc. Then what? Then we would go ahead and observe. We did that. We showed up early to see if those two people were showing up together. Inspection, we would go ahead and take a look at that inventory sheet to see that it's being signed off by the supervisor. We could also do analytical procedure. Okay, an analytical procedure at this stage is at a high level, okay, and it would pretty much be comparing, say, last year's financial statements to this year to see if there's any significant change that would help us to really take a good look at the internal controls and see if there's been something for a particular account balance that we want to focus on even closer in helping us to determine the risk of material misstatement. Okay, but we're doing our risk assessment procedures here. Now, when we look at those, we would look at the nature of the entity. What do we have? A jewelry shop. We would look at external factors. We talked about maybe there being a bad economy that's affecting the potential that somebody would be stealing. But we'd also look at regulatory factors. Again, if we're looking at, say, oil producer, obviously there's going to be some regulatory issues. We looked at the internal control. Okay, and then we would, of course, understand the nature of the business. But these are the type of factors that we consider during that obtaining the understanding phase when we're conducting our risk assessment procedures. So it's just not the internal control, which is really where we focus most of our discussion here, but we are looking at these other factors as well. It's not just the internal control. There are external factors, the environment of the company that we're considering as well. Going over to the next slide, as we consider the nature of the entity, and of course we're going to want to understand their organizational structure, understand things about management, and we probably would have done some of those things early on. Understanding the sources of funding that is coming into this entity, so that's very important. Investment activities, for example. Understanding the operating characteristics, including the size and complexity of the entity. We would expect that a larger entity would have a more sophisticated set of controls, obviously, than would a smaller entity. So we're going to look at all of those nature of the entity factors. We would obviously want to consider industry regulatory considerations. If we have a client that is particularly susceptible to changes in technology, we're going to want to take a good look at that. The regulatory environment we've mentioned a number of times now. What are government policies, etc., that could affect the entity's business? And then, of course, other external factors such as, and I think I mentioned the economy, looking at the general economic activity. If there's a recession, etc., that could affect our inherent risk all the more. So when we talk about these industry regulation, other factors, these are really getting into more the inherent risk part of our audit risk formula. Obviously, then we look at to what extent the internal controls would help to then mitigate not only these environmental factors, but then, of course, factors that are specific to the account. And again, when we look at those risks, we look at them in terms of how they relate to financial statement assertions. And we're going to start to get into that discussion here in a couple seconds. Before we do that, though, let's go ahead and take a look at a couple of more questions from your homework. And notice we're talking about inherent risk factors now. Okay, and we say that all of these are inherent risk factors except what? And supplies inventory being difficult to count is not a inherent risk factor. That's a detection risk. If it's difficult for us to count, then we're saying the auditor could have some problem detecting the material misstatement here. All the rest of these would clearly be inherent risk factors. They're not control risk factors, non-routine transactions is almost the same as something being complex. Non-routine, we can't really get a pattern on those. Things not being processed systematically, again, inherent risk. If there is a random nature to how transactions are processed, that then again is something that's inherent to that particular transaction, that particular account balance. These aren't really dealing with environmental factors that we would consider. These are more related to the accounts themselves here, but these are clearly inherent risk factors, and we would look for controls to help us to mitigate some of those that the company has put into place, that the company uses to help mitigate those inherent risks. Okay, which of the following procedures would not be used to obtain an understanding? Well, we observe entity operations. We had those cameras that we were looking to see that they were using. We could perform the entity's processes. In our little example, we were more observing how they would prepare, how they went through their processes, but we might ask if we can sit there and see how the cameras are used by security personnel to observe what's going on, etc. That would be more of a reperformance. And then review prior year's audit documentation would be a good way to obtain an understanding of the entity and its environment, because all of that would have been documented previous year. Verifying the inventory subject to technological obsolescence. This is, again, focusing on detection risk, okay, which is not part of our obtaining the understanding phase, where we are looking at more our inherent risk and our control risk. This is a detection risk issue, and this is a substantive procedure. When you start to see the word verify, they're talking about substantive procedure, and that is not something that we're doing during our obtaining the understanding phase. Okay, so we're seeing some terms here now that hopefully you have recognized from the slides that we looked at. We called the risk assessment procedures, in which we're making our assessment of the risk of material misstatement, which we now know involve inherent risk and control risk. And when we do that, we are in the obtaining the understanding phase of our risk assessment procedures, and we make our assessment of risk of material misstatement, and we respond through our detection risk. So hopefully you're seeing a pattern now with some of that terminology. Okay, so let's go ahead and let's take a look now at how we will respond to our assessment of the risk of material misstatement. And there are two potential levels of response. One is at the financial statement level, and if we're responding at the financial statement level, okay, we will go ahead and develop an overall response to that. For example, we will assign staff to the job accordingly, to the engagement accordingly. If we have a higher financial statement level risk, we're probably going to assign a more experienced staff to that engagement. We'll see how that works a little bit later. If the risks do not relate to the pervasiveness of the financial statements, then we will look at we'll go in and determine what might go wrong. We start focusing at the assertion level. So we have to consider our assertion level risk as well, and we ask ourselves what might go wrong at the assertion level. Again, that is called potential misstatement. Okay, what could go wrong at the assertion level we call potential misstatement. Okay, and I'm just going to abbreviate potential misstatement, and we're going to try to see potential misstatement. I guess that's abbreviation of that, and we're going to see how we will then design our audit procedures at the assertion level. Okay, so we're going to look at each of these on the next couple slides. So if we are responding at the financial statement level, okay, we're going to now have these general responses, such as the personnel that we assign to the engagement, so we're going to go ahead and probably assign a more experienced staff to that engagement. Maybe the manager that's running that will put a more experienced individual on that. Now you come over and take a look at this next slide, and this is now our assertion level response. Okay, when we go to the assertion level response, okay, I put together this little chart to illustrate how that would work. And of course, you know, we are auditing the financial statements, and so there's accounts there. And often, if your account is, say, sales, you would look for the related account. Sales and accounts receivable are related, so you could probably audit these two simultaneously, or while you're getting evidence for account receivable, realize that you're also getting account evidence for your sales and vice versa. But we don't get too far here. We think about assertions. Remember, we had our assertions in the earlier chapters, and we talked about existence or occurrence as being an assertion. Okay, now we think about potential misstatement. What could go wrong at the assertion level? We're calling that potential misstatement, and we say here that a sale and the related receivable is recorded, but the goods were never shipped. Okay, so sale related and the related receivable is recorded, but the goods are not shipped. Okay, also the account is not properly adjusted for a sales return. So this is the potential misstatement. Under the existence assertion, they recorded the sale, they never shipped the goods, or if the goods were returned, they didn't put the return in. But then we also look at what? Environmental factors, and so we say that the company operates in a very competitive environment with minimal profit margins. Now, we are then, and these factors, guys, notice as we look at the account and the potential for the misstatement, we're thinking about our inherent risk factors here, right? But then we have to look at the controls to see to what extent the control technique procedure could potentially mitigate that risk. And we sit here and we say, well, the individual that completed the sales order and submitted the sales order follows up with customers to confirm satisfaction with goods. Now, what do? We go ahead now, and remember, on every engagement now we have to make an assessment of the risk of material misstatement. And in this example, I went ahead and said, well, I don't like these controls. Okay? I'm not happy with these controls because the design, remember we look at design and implementation, is not sufficient to allow for a lower assessment of control risk. There is no separation between the preparation of the sales order and the control technique. In other words, the salesperson that is calling, I think it would help if we looked at the control. Let's back up and look at that individual that completed the sales order and submitted the sales order follows up with the customer for satisfaction with goods. Now, think about that. And this is why I'm saying the design of this control is not good. The person that made the sale maybe is the one that recorded a fictitious sale so that they could get a bigger commission out of this sale. And so that's not the person that you want also saying that they called the customer to confirm satisfaction with goods, which would be a good procedure if it was done properly for the existence assertion, because the customer would be saying to whoever of the client personnel called them, oh yes, I love this thing, or gee, I had this problem. But at least we know there was a sale when that individual, other than the person who made the sale, is calling and saying, are you satisfied with those goods? If we rely on the person who made the sale, they may just falsify that they made the call as well, and we would not detect that misstatement in the sales account receivable occurrence assertion. We wouldn't catch the potential misstatement. And when we say catch, I don't mean the auditor, I mean now the control technique instituted by management and carried out by the employees. We wouldn't catch that potential that the sales recorded but the goods were not shipped. Also, we say in walkthroughs, it appeared that the control was not implemented. There's our key words: implementation, and what? Design. We didn't like the design, and we did a walkthrough, and it seemed that the staff were not familiar with the policies. And again, we bring out the environmental factors as well. So in the end, we assess our risk of material misstatement at high, at the maximum. We set it at 1. You could use quantitative or qualitative terms. Because of that, we skip the control testing, and we would move directly to our substantive testing now. And notice here we're saying confirm accounts receivable, etc. And we are going to use a procedure that is effective to help detect misstatement now in our existence occurrence assertion by pulling a sample from the financial statements and sending out the confirmation letters to help us with the existence assertion. And we're going to get more into specific substantive tests as we move along, but remember, we always line up the substantive test with the assertion. Also notice that when we look at the internal control, those are lined up with the assertion. We're looking for internal control that will prevent or detect that misstatement in the assertion. So we look for the appropriate control to prevent or detect a misstatement in the assertion, and we choose a substantive procedure that will help us to detect that misstatement. And notice we have our risk assessment procedures, and when we get into the testing phase, we will come in looking at our control testing and our substantive testing. Now, you come down to this second example down here now, and notice I still have the same account, I still have the same related account, I still have the same assertion, same potential misstatement. But now I've gone ahead and I've changed up the facts about the control procedure a little bit, and let's just go ahead and read through some of that. So now what? We say that a sales manager follows up with customers on sales orders prepared by the staff to confirm satisfaction with goods, and confirms quantity shipped and enters that all on a call log. The manager signs off on the call log, and the call log is forwarded to an internal audit staff who follows up monthly on a random sample of calls to reconfirm what's entered on the call log. So now we've got what? We've got separation, we've got the sales manager making the call, we've got documentation that the control was implemented, and we've got additional design going on here where we have a second party, the internal auditors. Remember, we talked about how we might be able to utilize the work of internal auditors on the audit in our last chapter, and so we would understand the work that was done by those internal auditors as well. So based on all of that, we go ahead and we set our control risk at low, and we say the design, remember, design and implementation is effective in that there's good, there's a manager that follows up, and so there's good separation of duty. Also, we have the internal audit staff involved, and remember, we're interested that the internal audit staff reports directly to the board of directors. Remember, we talked about that as a PCAOB requirement, and we would expect any company with a good internal audit staff and good structure, entity structure, I should say, with internal audit staff, they report directly to the audit committee. The board of directors is something we would be looking for. In walkthroughs, right, we observed the call being made by one manager who seemed to understand the process well. So now we've got evidence of what? Implementation, right? Design implementation. Further, we observed the call being made by the internal audit staff and actually participated in a few calls. Again, this is all during the obtaining the understanding phase and seeing that the controls are well designed and implemented, and then we've got involvement from the board of directors who are worried about the competitive environment of the company, etc. So what do? Well, now we have to test, remember, key phrase, operating effectiveness. So we're going to test operating effectiveness for these controls, and we're going to look at those call logs that are maintained by the internal audit staff, and we're going to review the call logs for sign off by the manager. So now we're taking a sample. If you just do a walkthrough, you only know that that control was working that one day. If you go ahead and you pull a sample of transactions that happened throughout the year, a sample of those call logs, and look at it, now you're testing operating effectiveness. We would review any of the internal audit staff reports and discuss any findings with the board of directors. But now we're sitting here and we're doing control testing, and assuming those control testing helped us to provide evidence of the operating effectiveness of those controls. Now, and remember our little teeter-totter slide, that because our control risk now that has been supported by testing of the operating effectiveness is lower, our substantive testing can be less in extent here, and so we're doing less of our substantive testing as a result. So this slide, this little chart here that I put together is hopefully helping you to see how all of this fits together now, and how it's a flow where we go from what? We think about the assertions, we think about the potential misstatement, we look for a control technique that'll prevent or detect the misstatement, we make an assessment of the risk of material misstatement, looking at that potential misstatement, our inherent risk, and our control risk together, and then we respond. And we saw that we could respond at a general level with how, at a financial statement level, with how we assign staff, but we also respond at an assertion level, and so we would respond through the testing phase and determine the timing, extent, and nature, finally, of our substantive test. Okay, so let's go ahead and start to take a look at the potential for fraud and how we will consider that here in our planning, and see how it's going to impact our audit risk, and see how we're going to respond to that. And then we're going to talk about the requirements for communications regarding fraud. So let's go ahead and take a look, and we can see here that fraud is distinguished from an error by intent. So if we look, we can see that errors are unintentional mistakes in what is put into the financial statements in terms of amounts and disclosures, where fraud is intentional. Okay, and it can be management, could be those charged with governance, our board of directors, employees, anywhere along the chain of command in the company, we could have fraud coming. So errors, unintentional misstatements, whereas fraud is an intentional misstatement. That's why we call them misstatements. We don't call them errors, because they could be intentional. And the auditor needs to maintain their professional skepticism when they find a misstatement and consider that it could have been intentional, it could be indicative of fraud. This idea of professional skepticism is a state of mind that it's really the job of the partner to remind the staff that they need to maintain that professional skepticism throughout the engagement and have a questioning mind. It doesn't mean that we assume there's fraud or that we're constantly pointing the finger and saying, well, this is fraud. But certainly if we see a misstatement, we have to look at that, step back and look at it objectively and see if there is a potential for fraud. So if we go ahead over to the next slide, we look, and there are, of course, again, we're reminding it's intentional. Okay, and there are two types of intentional fraudulent considerations that the auditor will have. One is fraudulent financial reporting, and then the other is going to be misappropriation of asset. Fraudulent financial reporting is essentially lying, putting down false information on the financial statements, essentially. And then misappropriation of assets is going to be stealing. And I'm going to write that down here because you won't be able to see it red on red. Is going to be stealing. Okay, so we have lying, we have stealing. Both of these are fraud, and the auditor is going to want to be concerned about those. Fraudulent financial reporting, misappropriation of assets. Now, taking a look at how the auditor will assess the risk of material misstatement, and notice we say the risk of material misstatement due to error or fraud. So the process is how we think about the risk of material misstatement. It's still going to be a similar approach that we took a minute ago for errors, but now we have to consider this intentional misstatement caused by fraud. Now, when we talk about fraudulent financial reporting, it includes manipulation, falsification, recording incorrectly information in the financial statements. Okay, so it could be any one of these up here. And I'm just trying to get my pen. Sometimes the colors here on these slides make it hard to find when it's going to show up. Manipulation, falsification, or alteration of accounting records supporting documents. Okay, so it could be the records, could be the supporting documents that they're providing us, could have been altered intentionally, and those are then used to prepare the financial statements. Intentional omission from the financial statements, not putting down liabilities, not putting down expenses. Okay, intentional misapplication of accounting principles. Okay, so they intentionally misapply an accounting principle to the end of whoever's causing that to happen. Maybe skewing the revenue recognition rules, for example, into their benefit. So basically putting information into the financial statements or altering supporting documentation to make the information that's in the financial statements be supported to try to fool the auditor, essentially, that what's in the financial statements is correct. And when we have misappropriation of assets, it's basically stealing assets, taking things home, okay, ordering things over the internet. These days, the way you can order things over the internet, they're going to go ahead and order those instead of using for the company. They're going to use them for their own purposes. Okay, so paying for those things, having the company pay for things that are then going home and being used for the employees or whoever is doing that, and then embezzling, stealing cash, essentially. All of these are misappropriation of assets. So misstatement of financial statements and the misappropriation of assets are the two types of fraud that we're looking for. And so fraudulent financial reporting, misappropriation of assets, those are the ones that's what we consider on a financial statement audit when we consider fraud. And we consider it, we could be concerned about the same sort of misstatements whether when it's due to an error, but if it's due to fraud, we're thinking it's intentional. So, how are we going to find out? How are we going to find out if there's a potential that our client has had some sort of fraud that has gone on? And we talk about sources of information here, but this is not so much a source of information as it is a first step that we would do. And this is amongst our audit team, our engagement team, okay, that we're going to talk about fraud on this engagement, and we're going to have a brainstorming. And this comes early on in the audit, maybe after you've taken a tour of the facilities, you've looked around, and you start to see some things that might be indicative of fraud, or even a susceptibility to fraud. Maybe you haven't seen things that are indicative of fraud, but you've seen a susceptibility to fraud, and you're going to talk about those. I've been on engagements where there's been significant amount of federal checks that are essentially they call them regional finance centers, where you see the government producing federal checks. And they do some of that work in San Francisco, and we led some work in the San Francisco office of GAO looking at how the government was processing those checks. And it's basically a factory in which those checks are just being churned out and mailed out. And this is a while back when more checks were mailed. Less people were probably on direct deposit at that time. But, this is definitely a vulnerability when you have all those checks being churned out, and they would put them on spools of 40,000 being churned out like that. And we went back and we did have some concerns about how they may be controlling that, and we took a good look at how they controlled the safety of all those checks that were being processed in this sort of factory environment where the federal government would churn out all these different checks. And we did see some vulnerabilities, and with a little bit of a different objective that our office has than just the pure financial statement audit, we went ahead and made some recommendations for improvement there. But certainly this is something that the team would check out, and through the brainstorming maybe identify some vulnerabilities or some other things that are indicative of fraud. I mean, obviously, if you saw this guy, you'd think there's really something wrong, but you're looking for things that may be indicative of fraud. Then you're going to start to make inquiries internally of the company, of management, employees, and others, and you're going to ask very pointedly, have there been instances or suspected instances of fraud? And you might ask it in a way that makes it sound like you actually know that there has been, and you may say, can you tell us about the fraud that's occurred? And maybe you'll find out that it has happened or has been suspected, and that's going to cause the auditor to think, okay, there's an increased chance of risk of material. My risk of material misstatement has increased due to fraud, and then the auditor is going to respond accordingly. Analytical procedures. Okay, and analytical procedures, remember we talked about last time, are something that is a type of substantive test, but there's a requirement, and we'll talk more about this later, that we do a analytical procedure during the planning phase of the engagement. And so when we need to do that during the planning phase, okay, we have to do analytical procedures, and the fraud standard tells us that we must do a planning analytical procedure over revenue. It is a requirement that you do some sort of high-level planning analytical procedure over revenue. You must do that. You must also do analytical procedures at the end of the engagement as well. And some of those analytical procedures we would do to see if there's anything unusual that could be indicative of fraud. But we also do that at the beginning of the audit as a planning step. We must do that analytical procedure over revenue. Now, why do they require that we do analytical procedures in planning over revenue? Well, fraud doesn't occur, or the ones that we're aware of don't occur in office supply account. The big frauds over the years, Enron, et cetera, have been over revenue, right? And so we're going to take a good look and do some analytics over revenue and see if there's something that jumps out at us that could be indicative of fraud. For example, a huge spike in revenue all of a sudden for a company that maybe is in an industry that is experiencing slow growth, etc. That could draw our attention then to revenue, and it could be indicative of fraud, and it's going to cause us to think that our risk of material misstatement is coming up due to fraud, and therefore, how are we going to respond? We're going to respond most likely, well, at a general level, at a financial statement level, but also at an assertion level, altering the nature, extent, and timing of our substantive procedure. So we also do analytics at the end, and really, these really would go hand in hand. Unexpected year-end adjustments, and we would find those kind of things by doing that set of analytics at the end of the audit. So there's a requirement that we do analytic procedures at the beginning of the audit and at the end, and to see if there is something unusual that comes up at the end that maybe is indicative of a last-minute adjustment that was done to engage in financial reporting fraud. So these analytics comparing last year's revenue to this year's revenue and planning, and then at the end of the audit against the auditor's expectations would be ways that we would identify potential fraud at the beginning and the end. This idea of being concerned about fraud, even though we're talking about in the planning, goes on throughout the engagement. Okay, and then we're going to identify fraud risk factors. Okay, if we see those fraud risk factors manifesting, then again we're going to respond accordingly to that. So if you take a look at this question here, auditing standards are required to make certain inquiries of management regarding fraud. Which of the following is required? And again, we're asking about knowledge of fraud that has occurred, so that if they answer, well, yes, then if there's been concern or actual fraud in the past, we're going to want to, take some steps to realize that that's increasing our risk of material misstatement because of fraud, and then we're going to want to respond to that with our substantive procedures. Let's take a look at a couple more questions on the next slide. And which of the following is a misappropriation of asset? And the employee sold, and they say 12 CD players. I think we'd just let the employee have CD players this day if they wanted to take. Maybe they're helping us to avoid some clutter by taking those 12 CD players. So obviously this question's a little dated, but look, clearly this is misappropriation of assets. Okay, none of these others are even to me look like fraud. Management estimates bad debt expense as 2% of sales when actually expected bad debt. Oh, I see. That's fraudulent financial reporting. This one, this is misclassification. So all these other threes, I guess, would look like the first, well, A and B here, if we were going in the order of the alphabet here, A and B would look like financial reporting fraud, and this looks like just a smart move. This looks like a refinancing move right here, so this is not fraud at all. Taking a look at this next one, which of the following is fraudulent financial reporting? Company management falsifies the inventory count, right? So fraudulent financial reporting is going to be falsifying what is in the financial statements. This one looks to me like it's going to be misappropriation of asset, misappropriation of assets. So only that first one is financial reporting fraud. So a couple things from your homework, your quizzes that you'll see a little bit later when you do that. Okay, so we said that we're going to look for the fraud risk factors, and there are 3 fraud risk factors that we have over the years seen are present when fraud exists. We have incentive and pressure, opportunity, and attitude. And it's a poor attitude, rationalization. Attitude or rationalization. Now let's think about these. Incentive and pressure. Incentive. Let's just use an example. If I am able to show an increase in net income, I'm going to get a bonus. This is incentive that could cause the company to engage in financial reporting fraud. Pressure. If I don't show an increase in income, I'm going to get fired. This could cause the company to engage in financial reporting fraud. Opportunity. Poor internal control. Okay, you can just put that down. Poor IC. Opportunity, in my opinion, the poor internal control, okay, is going to be the leader here, in my opinion. If you see poor internal control, then it's a matter of waiting for the fraud to have occurred. I was on an engagement where we were looking at how the Department of Veteran Affairs ensures that payments to veterans are correct, and sometimes veterans are paid for injury, and there was no concern about whether a veteran who had been injured was receiving any other sort of payment, such as Social Security, for their compensation for having been injured in the war, etc. And so the Department of Veterans Affairs at that time was not comparing their compensation for injury payment records against the Social Security payment records, because there was no limitation on the pay for the injury predicated on income when someone was injured in the war, so it didn't matter if they were also getting Social Security. The problem that we had with that is the federal government receives death information through Social Security. So our concern was that there was a potential, because that control weakness, that they would be paying individuals who were already deceased, and you don't continue to get benefits after you're deceased. And so we investigated and found out that indeed, and we found some cases where the payments would go on for 7-8 years after the veteran had been deceased. And at that point, Department of Veterans Affairs was having trouble recovering those funds when that fraud had occurred, because at that point it might be, taking money from the children of a deceased veteran or the wife of a deceased veteran who had been injured in the war and had been receiving compensation payments. So our recommendation was that they compare their payment records against Social Security records to ensure that they don't pay individuals who are deceased. There's no benefit that continues after you're deceased for something like that. The compensation payments go to the veteran, not their family members. But again, it was the opportunity, the poor internal control, the fact that they weren't comparing their payment records against Social Security that was indicative of a potential for fraud. And sure enough, there it was once we saw that fraud risk factor. And then attitude or rationalization. What? The person says, hey, I've been working here 30 years, nobody cares about my efforts, and then they get themselves in a situation where they start taking funds from the company. Now, when we look at these fraud risk factors, what we're going to do is we're going to want to see how they affect our inherent risk and our control risk. So we want to see how do they affect the risk of material misstatement, right? And if we see that these fraud risk factors are driving up our RMM, then we're going to want to respond correctly through our detection risk, right? And so what happens? I'm thinking that the opportunity to carry out the fraud is poor internal control, and so that's obviously going to affect our control risk. It's going to drive it up, right? Okay, and if we have that, then that's going to be a concern of ours, and we're going to have to respond through our substantive testing. Incentive and pressure is probably going to drive up our inherent risk a little bit, or could be a lot if we actually see the incentive and pressure, because now we're going to start seeing that cash is going to be more susceptible to being stolen. We're going to see that we're going to have the potential for making transactions complex so that maybe the fraud can be concealed from us. Okay, rationalization attitude is probably going to impact our inherent risk. Okay, but it could, and it's often, when you see this attitude, it's often a bad attitude by a dominating management that starts to override the internal controls. So it could affect the internal control as well from that angle. Okay, but again, we're looking at these fraud risk factors and we're seeing how do they impact our risk of material misstatement, and if they drive our risk of material misstatement up, we see the fraud risk factors present and they're driving our risk of material misstatement up, we're going to respond how? Through our detection risk. We're going to put some procedures in place that will allow us to detect that material misstatement due to fraud. So we look at it from the standpoint of errors, and we've talked about the audit risk model in our RMM in the context of errors, but now we're looking at it in the context of potential fraud. Now, when we look at these different things, incentive and pressure, and I think this person's having pressure, it looks like, and this is really what it is. There's pressure to meet the press releases in terms of what our earnings are going to be. There's financial stability is threatened. Okay, profitability is threatened. Management's personal financial situation. Okay, again, these are all pressures. Incentive is basically thinking that you're going to get some sort of bonus or something if you show a better net income. So all of these are incentive and pressure. When we see these sort of things, and by the way, we say incentive and pressure, and that is a category that we need to remember, but you need to also think about it from just these more detailed examples of the items that are indicative, so that when we see these things coming up, then we start to say, well, since these are present, they're probably going to affect our inherent risk. Our RMM is going up, and so we need to respond accordingly through our detection risk. Going over to the next slide, opportunity. And notice, well, they're saying opportunity here is complex complex or unstable organizational structure. I thought they were saying complex transactions. That's usually inherent risk. But an unstable organizational structure, very difficult to know what the appropriate controls are, etc. But the key is the deficient, in my opinion, the deficient internal control is going to be indicative of fraud. Ineffective monitoring of management. Classic there is that management fails to reconcile their inventory records to the physical inventory. So they're looking at sort of almost how this guy is. He's looking at a piece of paper here saying that he has computers, laptops, but they never bothered to actually go and physically check to see that the laptops that they've issued to the employees are still on the premises, or still in the possession of the employees. And by the time they get around to doing that, those computers are already gone. So periodically there should be reconciliation between your equipment, your property records, and the actual equipment to make sure that it's still there. So all of these really are pointing towards internal control, in my opinion, and that is the opportunity. That's going to affect our control risk. That's going to affect our risk of material misstatement. So we would do additional procedures if we saw those potential vulnerabilities, those weaknesses in internal control, and we would do procedures around that through our detection risk, through our substantive procedures. Going over to the next slide, rationalization attitude, okay, and we can see that there are some things there, and to me, the big one here is overriding the internal controls, okay, overriding the controls. Okay, override the controls is when we start to see a dominating management coming in and, basically telling the employees, if you want the job, go ahead and make the journal entry. That's a bad attitude, okay? Okay, and then they give us some specific examples, coming over to the next slide, of indications of fraud related to misappropriation of assets, and they do a nice job here of breaking them into our various categories here, starting with incentive and pressure. I'm going to go ahead and I'm going to change that back to yellow. I think will show up a little bit better here. Okay, incentive and pressure, and personal financial obligations may create pressure, okay, to steal cash, right? Inadequate internal control. I think you are now heard enough from me now that when we talk about opportunities, I'm thinking poor internal control. And then attitude, rationalization, disregard for the internal control, okay, overriding the internal control, disregarding the need for monitoring. All of these things are potential that's going to lead to misappropriation of assets. So again, when you see those fraud risk factors, you respond through your detection risk. Okay, so let's take a look at some more questions from your homework and from your quiz. And the auditor can respond to an increased risk of fraud by doing all of the following, except we're not going to increase detection risk. We're going to decrease our detection risk by taking steps on our substantive procedures, nature, more external evidence, extent, larger sample sizes, timing, doing more year-end testing, at a financial statement level, assigning more experienced staff to the engagement, maybe increase supervision, maybe the partner is visiting that audit site more. All of these are ways of not increasing detection risk, but decreasing it. Which of the following characteristics most likely would heighten the auditor's concern about the risk of fraud? And what? Management places substantial emphasis on meeting earnings projections. That's a rationalization. That's incentive and pressure, and we saw that if they're particularly concerned about that, that would lead them to engage in financial reporting fraud, and that falls under the incentive and pressure category. These others, and turnover of senior accounting personnel is low. That's probably a good thing, although it could be an indication that maybe there's someone there that might have a rationalization attitude. But we would look to see that those individuals are taking the appropriate vacations, etc. But the one that was going to really heighten the auditor's concern is this emphasis on meeting earnings processes. Insiders recently purchased additional shares of the entity's stock. I don't think that's going to make them want to steal. That's going to make them want to see that the company performs well and that stock increases in value. The rate of change in the entity's industry is slow. Well, look, if we do a planning analytic and then we see a larger increase in revenue than against the industry, that might cause us to be concerned about fraud. But that's not really something that's going to most likely heighten the auditor's concern. I think this second one is the classic concern here. An auditor learns that a client's employee is in control of inventory, gets divorced, and is responsible for paying a large amount of child support. All of the following of the audit of inventory likely are true, except, again, we're not going to increase detection risk. The auditor controls detection risk. Detection risk doesn't happen. The auditor tries to control that through what? Through our nature, extent, and timing of our audit procedures, and we're going to try to lower that detection risk, not decrease it. Although I think it is really hard, guys, in my personal opinion, to try to get this kind of information. This gets a little personal here. I mean, I'm not exactly sure how you would get that. I guess through discussions with management and the employees, but I don't know. That's a little rare for something like that to actually occur. And I think that the opportunity factor is really what we're looking for. Okay, so once we have done our substantive procedures, of course, that could potentially lead us to some findings that are indicative of fraud. And if that's the case, then we're going to try to get the evidence to see if it indeed is fraud. We'll probably expand our sample sizes, look more closely at that. I notice they put some glasses up here. So we're going to look more closely at that to see what is going on, and then consider the implications of that throughout the audit. Now we're going to talk about how that needs to be reported. And by the way, when we say consider the implications for other aspects of the audit, once you find fraud, you have to go back and think about every decision you had made up until that point. For example, Were my sample sizes large enough? Am I doing enough year-end testing? Am I using enough external evidence? All of that gets thought through again, because now it's not a question if you had fraud, you actually had found it. Now, once you have identified the fraud, you need to report that to management one level above those involved. And we're going to talk specifically about reporting here in a couple of minutes, but that needs to go at least one level above. So if it was the supervisor, if it was the clerk, you're going to report to the supervisor to the manager. What if it's a manager? You're going to senior manager. What if it's senior management? That must go directly to those charged with governance, the audit committee, and we're going to see that on the next slide. Now, what happens if it's a material misstatement? I mean, if the clerk steals $1 million, are you just going to go to the supervisor and say, hey, they stole $1 million? Clearly not. That then has to go to senior management and those charged with governance. Okay, so it has to go to the appropriate level of management. The auditor may want to consult with legal counsel, and if it's something where it looks like it's involving those charged with governance, the auditor may want to consider withdrawing from the engagement. Again, remember, we're trying to avoid dealing with management that lacks integrity, and that's always an option for us, to cut our losses at that point and just withdraw. Okay, going over to the next slide now, and again, fraud involving senior management or that causes material misstatement must be reported, and if it didn't involve senior management, then we would also include them in the discussion if it was a material misstatement. But obviously, if it involves senior management, that must go to the audit committee. Okay, so we report one level above, and if it involves senior management, it goes to the audit committee, those charged with governance. If it involves a material misstatement, it goes to audit committee and those charged with governance. Okay, good. So let's go ahead and take a look at the next slide. And there should be the appropriate disclosures regarding fraud. And often we tend to think, well, when you find fraud, you immediately, call the police or something, or that might be the way you think about it. But we really are going to report that internally to senior management and those charged with governance, and we typically don't go outside the entity, but there are certain obligations, and when the standards have called out that yes, you will actually report this kind of fraud externally. So let's go ahead and take a look at those exceptions, and we say to comply with regulatory legal requirements that say certain types of fraud must be reported outside of the company, and there's specific ones with the SEC, etc. When the successor auditor makes the inquiry, remember we talked last time about the required inquiry that the successor has to have the predecessor in Chapter 3, and one of those was about fraud, suspected instances of fraud. If we are subpoenaed, brought to court, there is no CPA client privilege. If you get subpoenaed, you're going to court, you're bringing your work papers, etc. Okay? And if a funding agency has specific requirements that we report fraud, and this is thinking largely about the federal government that provides federal financial assistance to various entities, state, local governments, not-for-profit entities, and they require that if you identify fraud that you put that in your report, and you report that out in your report on compliance with laws and regulations. So these are instances when we would report the fraud externally. Typically, it's going to go what? One level above. If it's a material misstatement, it goes to senior management and those charged with governance. If it causes a material misstatement, the fraud does. and if it involves senior management, it's got to go to those charged with governance. It usually stays inside, but in these instances here, then we would also report that externally. Okay, so let's take a look then at our documentation as related to our assessment of risk, both those that are considering fraud, but also just in general our risk of material misstatement that we talked about that are not necessarily considering the fraud risk factors. And so we have to have a discussion amongst the engagement team. That's that brainstorming. Then what? Procedures performed to identify and assess the risk of material misstatement. And we talked both as it related to fraud, we would ask about that. But we also had questions regarding the procedures that we did in our obtaining the understanding phase, just related to errors as well. We would look for the fraud risk factors and what additional procedures have been applied as a result of seeing the fraud risk factors. So if we saw incentive and pressure, we saw opportunity, we saw rationalization of attitude, how did we respond? We responded at a financial statement level by assigning more experienced staff to the engagement. We responded at an assertion level by using more external evidence instead of internal evidence, etc. So what was the nature, timing, and extent of our procedures performed as a result of, in response to our fraud risk, right? Because we said that it affects IR times CR. How did we respond? We responded by doing what? By lowering our DR. How did we lower our DR? Again, remember we had the what? Timing, extent of nature of our substantive procedure. And I'm putting that going up there to remember our little slide that we had earlier where we're going to increase our substantive. And when we increase it, and you can remember that by the way through net, nature, extent, timing of our audit procedure. Nature, more effective procedure using external evidence instead of internal evidence. Extent, larger sample sizes. Timing, doing year-end testing instead of interim testing. And then if we had communication about fraud, what were they? Okay, so you can see that there's a close relationship to the general discussion that we had about our risk assessments and what needs to be documented there versus how that looks if we are talking about fraud. But notice we bring them together, right? Errors or fraud. So we have to consider that potential for intentional misstatement, and we need to consider those fraud risk factors. And if we see them, we need to document how we responded to those specifically. Okay, let's take a look at this question, which when is a duty to disclose fraud to parties other than the entity, senior management, and audit committee. And there we go. There's our successor auditor. If they ask about that, the predecessor, well, not if, when. They are required to inquire about that before they can accept the client. And we are required to respond to that and give them the information about fraud that we are aware of. Okay, let's take a look at this next one. Which of the following is correct concerning required auditor communication about fraud? And it needs to be what? If it involves senior management, yeah, and this is beautiful right here, and this is right out of our slides, it needs to be reported to the audit committee, regardless of the amount. We start getting to the audit committee when it's maybe not. We maybe won't provide that to the audit committee when it's not senior management and it hasn't involved a material misstatement of the financial statements. But once senior management is involved, then it has to go directly to the audit committee. And if it's material, it must go to the audit committee regardless of who perpetrated that. Okay, good. That's a lot of information, but we're moving along. We're through Chapter 4, and now in Chapter 5, we're going to start taking a good look at some of the internal control process a little bit better, that we've been sort of seeing how we assess the risk, but now how do we test the operating effectiveness of those controls, and we're going to start to get into that here on some of the in Chapter 5. So good work. You saw some of the homework and the quizzes, and I'm going to start doing that where I'm going to put these homework and quizzes, embed those in the slides so we can go through those together on the screen. And I will see you in a little while here for our summary.